Alex Crooke, welcome to Questioning the Manager. So let's start with the US. We had a manager change there. How has it been performing?
Yes, I've been very pleased actually with our US performance in the Bankers Investment Trust. We've concentrated the exposures really to sort of three themes: energy efficiency, particularly around motor cars, paperless payment, and also sort of disruptive technologies, particularly in the internet. And the latter two have done very well. We've definitely had some great winners in the disruptive technologies area. Paperless payment is going very strongly as well, particularly the credit card processors there. Really strong adoption with the new iPhone, which has a paperless payment chip within it. Energy efficiency has been more challenging. Obviously, we've had issues around diesel cars, Volkswagen in this last 12 months. We don't own Volkswagen, but I think just been difficult around that area. But I think really the longer term, very much the Americans want to embrace energy efficiency. So I'm very hopeful the returns can be improving there. But generally very happy, and it's outperformed the broader US index over the last 12 months.
Okay, have you been up in the weighting there?
I think I've held it about where it is. It's grown to nearly a quarter of the fund, so it's 25%. And I'm happy there. I think the share prices in the US have performed very well this year against the backdrop of difficult earnings, and particularly a strong US dollar for those exporters has taken the shine off their earnings numbers. And it's not an area that I really want to allocate more money to given the valuations there. So I think we look to really cap it around about this level.
Okay, and how are you doing in China? Because there have been market turmoil there, really.
It's sort of been a year of two halves. First half was very, very strong performance, particularly in the A-share local market, but also in Hong Kong. A lot of enthusiasm for new age technology shares, as well as traditional stocks as well. So the market had a very strong period, hit some very high levels, and sold off through the late summer. What we did is took some profits around that time, increased the cash within our China sleeve, and also reorientated some of the stock selection to more defensive positions in more consumer areas, less financial. So a reasonable amount of action within the portfolio. Again, as a year, very strong performance for us from that area. And it's an area I think we'd look to see if we see support in the Chinese economy, that it's not entering what it is, that it's still growing reasonably well and not entering a recession, then I think we're likely to increase the allocation there in the coming year.
Okay, let's have a look to your fantastic dividend record. It's been growing for 48 years. Where do you earn the income? And being a high-paying dividend market, does lowering the UK weighting affect this?
I think that the two markets which definitely have the highest yield within our portfolio are the UK and Asia. So those two areas in that sense over-earn or earn a lot of money for us from the income point of view. But having said that, all regions contribute, and very much there's a strategy within our stock selection which favours companies with strong dividend growth. So we're looking for companies, they might be relatively low yielding on purchase, but if we can see how strong cash flow leads to strong dividend growth, then that'll pay out over a period of years. And we're beginning to see the fruits of that strategy come through in the last 12 months. Where particularly Japan and America are both showing very strong dividend growth, admittedly from a low level.
Okay, finally, let's just go towards the performance fees. These were abolished a couple of years ago. Has this changed the way in which you approach investing in the fund?
Not personally. They were abandoned really in the reflection of what's called RDR, the retail review there, distribution review, and saying, well, we should, as an investment trust, in terms of the fees we charge, let's try and be as low as we can, and actually very comparable to open-ended products. And so I think taking away the performance fee, we have a base fee of now 0.45% on assets, but a cap at 750 million, where anything above that is at 0.4. So again, as the trust hopefully grows in assets over time, that the net fee should fall a little bit towards that 0.4 level. So I think very much it's good value. That looks very good against its peers. Other costs are very low, so the ongoing the total charges is just over 0.5%. So again, I think very competitive against open-ended trusts, and that was the aim of that change.
Okay, Alex, thank you.
Thank you.